What's up, everybody? Thanks for tuning in today to another episode here on Selling Vega. It's another exciting day as we continue our charts, patterns, and indicators series and talk about another technical momentum indicator, Bollinger Bands, what it is, some common trading strategies that utilize it, and how I personally like to use it in my trading. Please don't forget to like and subscribe to my page and hit that alert button so you guys know firsthand when my next videos drop. Now, without further ado, let's get started. All right, so let's get right into one of my favorite indicators here, Bollinger Bands. A Bollinger Band is a technical analysis tool used to predict future price movements by using three trend lines to signal potentially overbought or oversold conditions. It consists of three lines, the center line being a moving average, which is usually the 20-day or 20 time period moving average, with the top and bottom lines being two standard deviations above and below that center line moving average. It was developed by a guy named John Bollinger in the 1980s, which is where it gets its name. A common trading theory or strategy for how traders use it is to trade against the momentum when the stock price finally hits either the top or bottom Bollinger Bands, with the assumption there being that these prices will retrace back inside of the bands. So go long or buy when you are at the lower Bollinger, like here, and sell or go short when you hit the upper Bollinger, like here. Now, to understand why these upper and lower lines indicate possibly overbought or oversold conditions, we have to quickly go over standard deviation and what it tells us. Standard deviation is probably the most common way of measuring dispersion in statistics. So when your data set is a bunch of stock prices, standard deviation can help you spot periods of stretched or extreme prices. Now, the whole idea underlying standard deviation is this assumption called normal distribution, which can be seen here. So normal distribution is this assumption of how data sets should look when it comes to every single one of the data points that comprises the data set. And the assumption inside of normal distribution is that 95% or roughly 95% of all data points in a data set can be expected to fall inside of two standard deviations. So it's useful in predicting that if one data point is maybe outside of two standard deviations, that perhaps the next one has a good chance of falling inside of those two standard deviations. And this is ultimately the fundamental reason why Bollinger Bands are popular and utilized as an indicator. Now, does this mean that trading Bollinger Bands will be 95% successful? No, not exactly, and we'll touch on a couple weaknesses with Bollingers when I explain how I like to use them a little later. Here's how you can add them to your charts. I guess we should just start from scratch here. You go to this indicators button at the top, and it's another built-in indicator, so you can just type in Bollinger Bands. This one right here is the one we're using. Now that populates on your chart, and let's go to the settings so you can see. So you see the length is 20, so that is descriptive of the time period or how many days your middle Bollinger line is going to be. And then the standard deviation is what will determine your upper and lower lines. So you hit OK for the 20 period with two standard deviations above and below. And here you have a traditional looking Bollinger Band setup on your chart. And just a reminder that this can be used on any time frame. And everything about the Bollinger Bands will hold true because the time period will just adjust on the middle moving average of that Bollinger Band. So you can use Bollinger Bands on the 5-minute, 15-minute. You could use it on the 1 hour, basically any time frame that you want to use it on, and the rules of the Bollinger Band, or I guess the strategies of it, will hold true. All right, so how do I like to use Bollinger Bands in my trading? I like to use it for swing trading, holding positions anywhere from 1 to 6 periods after entry. Since Bollinger Bands are based on the 20-period moving average, it should definitely be used in shorter time period trading. So an example here would be IWM touches its upper Bollinger on March 11th. If you held for a couple days, you may have stopped yourself out for a loss, but if you had held for 4, 5, 6 days, you would be well into the green. It does sometimes take a few days for the momentum to switch and for retracement back to the middle Bollinger to take place. That's why I usually like to hold my positions anywhere from 1 to 6 days before exiting, while maintaining some sort of risk management with a stop loss or something of that nature. I also like to use it in conjunction with other indicators. Bollinger Bands are a momentum-based indicator, so I like to pair it with a more volume-based indicator such as RSI or volume profile, as well as looking at candlestick patterns to provide an even deeper picture of the price action. If you use all of these things together, you'll find, I think, that you'll be more accurate in your entries and exits. And finally, I like to use Bollinger Bands on more broad-based assets because they are harder to consistently reach extreme or stretch conditions and stay there for long. This helps increase the likelihood that a retracement will happen sooner, because at the end of the day, continuation trades of just constant momentum either to the upside or downside are harder to have happen on larger cap names like Apple, Microsoft, even more broadly on indexes like the Russell 2000 or the S&P 500. All right, so let's talk about a couple weaknesses in the Bollinger Bands. First is going back to that normal distribution. Again, this is under the assumption that the data set that you're looking at falls under the normal distribution category, which for stock prices, we just can't confirm that that's the case. So we are working under an assumption with these 95% numbers. The other weakness is that Bollinger Bands are ultimately based on a lagging indicator in the moving average. So it means that the Bollinger Band lines will track the stock and thus will move along with it. So when strong momentum takes a stock to either Bollinger Band in a high volume, volatile fashion, it might be a time to actually avoid taking the other side of the trade. In fact, John Bollinger himself, in his rules for trading the Bollinger Band, noted that a closing stock price outside of either bands is typically an indication that the breakout momentum will continue. I will provide the link to Bollinger's trading rules in the description below this video. All right, so just to wrap things up here, Bollinger Bands are definitely a very popular indicator used in momentum-based strategies and certainly deserves to be looked at knowing that traders and algorithms are also incorporating it into their strategies. Understanding standard deviation will help you understand why conditions are extreme at the upper or lower Bollinger, but also using this along with other indicators can help you be more accurate with knowing when exactly is the right time to enter or exit a trade. So this is definitely an indicator that I like to incorporate into my trading, and I hope you guys do too. So add Bollinger Bands to your charts, check out some stocks and how they look now that you've added the Bollinger Bands, and feel free to drop any questions or comments in the comment section below. Please don't forget to like and subscribe to my page, as it really does help me continue to help you guys. Happy trading, let's make some money.